All right, let's jump right into this explainer. Today, we're looking at the ultimate financial illusion. We're going to break down how massive amounts of money can completely vanish and then reappear without a trace. We are analyzing the shadow markets, specifically the architecture of something regulators call mirror trading. Now, I know it sounds like a concept straight out of some espionage thriller, but it is a very real, incredibly complex mechanism functioning right beneath the surface of global finance today. So imagine for a second that you're trying to move millions in illicit funds across international borders, and you absolutely cannot get caught by the authorities. You can't just wire it directly from one bank to another, right? Compliance alarm bells would go off immediately. The modern banking system is completely fortified with endless checks and balances. And physically moving it, the logistical risks are just astronomical, totally impractical. You need a way to transport all that value silently, cleanly, and without triggering the massive surveillance apparatus designed to stop financial crime. So how exactly do you bypass the gatekeepers of the global economy? Well, the answer is actually surprisingly elegant. You just hide it in plain sight. To the naked eye, and honestly even to sophisticated monitoring software looking at a single transaction, this method just looks like an ordinary, completely legitimate day on Wall Street. It leverages the very lifeblood of the global economy, the vast interconnected capital markets themselves, as an invisible cloaking device. Instead of sneaking through the back door, these funds walk right through the front door, totally disguised as everyday business. Section 1. Financial disguise, the perfect cover. Okay, so the crucial starting point is understanding exactly what this term means. Mirror trading is basically an offsetting securities trade used to move value, obscure ownership, and disguise illicit funds as legitimate market activity. Instead of using the market for genuine financial exposure, like trying to make a profit off a rising stock or hedging against a currency drop, these actors are using capital markets for concealed currency conversion. They are effectively laundering money through securities transactions, taking advantage of the speed and scale of institutional trading to sanitize capital. The actual mechanics of this sleight of hand are brilliant in their simplicity. It breaks down into three very precise steps. Step 1, a party buys a highly liquid security, usually a blue chip stock, in market A using their local currency. Step 2, another party simultaneously, or maybe near simultaneously, sells the exact same or a closely matching security in market B, usually in a stronger, more desirable currency like US dollars or euros. Step 3, the value is quietly shifted across entities or jurisdictions. You buy over here, sell over there, and the trades offset economically. The money practically teleports from one corner of the globe to another, while the whole transaction just looks like a standard broker executing a totally normal order. Now, here is where it gets really interesting, especially from a regulatory perspective, because intent is everything. Think about genuine trading. It's driven by real-world market strategies, right? We're talking about hedging risk, executing client portfolios, managing liquidity. Real trading inherently carries market risk. You might win, you might lose. Mirror trading, on the other hand, is completely 100% economically neutral. The traders aren't trying to beat the market at all. They're intentionally eliminating risk, using the market's robust infrastructure just as a conduit to camouflage the movement of value between accounts, affiliates, or distant jurisdictions. The entire reason this architecture works is because the primary objective isn't to make a return on an investment. The non-market objective is the whole point. The actors are totally focused on moving value, changing a restricted currency into a global reserve currency, obscuring beneficial ownership behind layers of shell companies, or completely distancing the funds from their original, potentially illicit origin. By hijacking the appearance of legitimate trading, they completely bypass traditional money transfer channels. It's a highly sophisticated method of regulatory arbitrage that literally turns the global financial system against itself. Section 2. Deutsche Bank. The scandal. To truly grasp the massive scale of this, we have to jump back to the year 2017. This is when the Financial Conduct Authority, the main regulatory body for financial markets in the UK, handed down a colossal fine to Deutsche Bank. They were cited for serious anti-money laundering control failings. And the core of those failings? It was tied directly to exactly the kind of mirror trading scheme we just broke down. It was a complete watershed moment in financial compliance, and it really remains the most profound regulatory example of this architecture being exploited on a massive institutional scale. If we look at the official documentation, the FCA's final notice explicitly calls out, quote, a suspicious mirror trading scheme involving customers in Russia and the UK, with concerns that one customer was trading on behalf of no-name companies, end quote. The authorities found these incredibly large trading volumes taking place that were just wildly inconsistent with the actual financial profiles of those customers. I mean, the sheer size of the trades made absolutely no commercial sense. You had entities with barely any declared assets suddenly executing multi-million-dollar institutional trades. That's a massive, glowing red flag that the system is being used to quietly siphon capital out of one economy and integrate it into another. And listen, we need to understand that this is definitely not ancient history locked away in some 2017 filing. The FCA specifically brought up this exact Deutsche Bank case again in their 2025 review on money laundering through markets. They highlighted a rising modern threat, stating that capital markets are increasingly being used to launder funds so that those funds appear legitimately generated from trading activity. Sure, the digital tools have evolved, the shell company structures are definitely more complex, but the underlying vulnerability, it remains a paramount concern for global watchdogs today. This threat is active, it's present, and it's constantly adapting. Section 3. Detection hurdles. Why it's hard. So why is this so incredibly hard to catch? Well, the challenge is entirely operational. If you take an isolated view and just look at one single trade, say a routine equity purchase in market A, it looks perfectly ordinary, totally legitimate. The trade settles, the broker gets their fee, and the compliance algorithms see absolutely nothing wrong. The smoke and mirrors are only revealed when you take a connected view. The suspicious pattern only emerges when surveillance systems can actually link the trades across different accounts, desks, corporate affiliates, jurisdictions, currencies, and timestamps. It's literally like looking at a single puzzle piece versus stepping back to see the whole concerning picture on the box. This builds directly on what the regulators themselves are saying. The FCA review notes, quote, "Capital markets facilitate the movement of vast amounts of capital. This complexity makes detection difficult." End quote. The sheer volume of daily transactions in global capital markets acts as the perfect white noise. When trillions of dollars are moving legitimately across borders every single day, slipping a few million through offsetting trades is incredibly easy to lose in that endless stream of data. The speed and the fragmentation of modern trading, they play right into the hands of these mirror traders. To complicate things even further, you have the intersection of risks involved. The European Securities and Markets Authority, ESMA, noted in their market abuse regulation review that even if a mirror trade doesn't qualify as classic market abuse on its own, since, it doesn't necessarily manipulate the price of a stock, it still creates massive vulnerabilities. It directly impacts anti-money laundering risk, it frequently touches on sanctions evasion risk, and it ultimately damages overall market integrity. When bad actors can just freely use the markets as their personal laundromat, the entire system is being exploited, and that really undermines the fundamental trust in our global financial infrastructure. Section 4. Catching traders, breaking the illusion. So, how do the good guys, the regulators and compliance teams, actually break this illusion? Well, catching the trick completely depends on controls that connect the economic reality of the trades to the actual identities and purposes behind them. Effective detection relies entirely on comprehensive surveillance and AML controls that successfully link related activity. You literally cannot just review transactions one by one and expect to catch a mirror trade. Institutional compliance teams have to monitor the entire ecosystem. They need to deploy advanced analytics to actively hunt for those invisible threads, tying seemingly unrelated trades together, bridging the gap between isolated data points. A mature control response means throwing multiple overlapping layers at the problem. According to FINRA's red flag guidance and the FCA's thematic work, firms need absolute clarity on who they are actually dealing with, meaning strong customer due diligence and rigorous beneficial ownership analysis. But beyond just knowing the customer, they have to actively monitor for paired trades that have absolutely no logical market rationale. They need to heavily scrutinize unusual cross-border client relationships, especially the ones using overly complex corporate structures. And finally, they need rapid escalation protocols for any trading activity that is wildly inconsistent with a customer's stated business profile. It's a highly comprehensive, pattern-based approach. You really have to see the forest, not just the trees. Which brings us to a rather provocative thought to end on. If massive amounts of illicit funds can be this expertly hidden as completely ordinary everyday market activity, what else is hiding in plain sight in the global capital markets today? It's a pretty powerful reminder that the very systems we trust to build wealth and facilitate global commerce can also be covertly used to transform and transfer value right under our noses. Thank you so much for joining me for this explainer, and remember, always look a little closer at the mechanics of what you're seeing.